everybody. Welcome to our webinar series on capital market development, China and Asia. And today we're very happy to have Professor Jesse SCHREGER from Columbia University to present his recent paper, Internationalization Like China. Jesse, you have 25 minutes, please.
So thank you so much for inviting me to give this talk. It's a real honor, and I appreciate Zhiguo taking the time to discuss. Do you see the slides? Perfect. So this is joint work with Chris CLAYTON from Yale, Amanda dos Santos, and Matteo Maggiori. And the starting point of this paper is really the question of how exactly do international currencies develop. So China and the Chinese government has, publicly stated that, kind of a strategy and a goal is to eventually transform the renminbi into an international currency. And kind of the core part of that strategy has involved gradually liberalizing access to the renminbi bond market. So essentially what we have is right now China has the third largest bond market in the world after the United States and the Euro area. And up until very recently, it was essentially segmented from foreign investors around the world. And that's begun to change quite dramatically recently. And so one of the big challenges here that we kind of see China facing and trying to understand is how exactly do you become the global store of value? Essentially, when we think of the global store of value, it's the confidence that in any state of the world, people around the world can essentially convert a unit of your currency into a certain amount of consumption or goods. How can you basically convince global investors that you are providing this global store of value while foreign investors are essentially fearing their ability to get money out of the country in bad times, given essentially the recent track record of China allowing this foreign investment? And so one of the things that's really going to come out of this model and our understanding is that this is essentially a slow and arduous process, that from the perspective of investors, the real question that they're going to face when they kind of consider whether to put their money into the renminbi or other national currencies is, what is the government going to do in bad times? And so the key that we're going to emphasize is that it's really going to be the government behavior in crises is going to be the key to building a reputation. And then, I'm not going to talk too much about this today in the short talk. We emphasize this a lot in the paper. We want to examine essentially how do international currencies compete. And so one of the key things we're going to kind of find is that essentially it's going to be harder to build a reputation when you're facing more fierce competition from rival issuers. And in particular, when we take it from the perspective of the United States of, as the kind of issuer of the global reserve currency, what could the US potentially do if it wanted to compete with kind of a rising China and Chinese renminbi? So in the particulars of the paper, we're going to begin by documenting 3 facts on the internationalization of China's bond market. First, we're going to find something that's really striking and different than the way other countries have internationalized. China's going to begin by initially raising renminbi denominated funds, local currency funds from stable and primarily official reserve holders, and only recently allowing in kind of flightier private capital flows. And we're going to argue that this foreign investor composition is really kind of a deliberate policy choice of the Chinese government. The third fact we're going to try to understand is, with any new asset, as the renminbi is in international portfolios, there's the question of essentially how is it perceived? What is this asset most like? Given the short sample, we're going to take a revealed preference approach and ask who actually holds this. And we're going to find that right now, the renminbi is essentially in between, kind of developed market and emerging market currency bonds. We're going to take these facts and we're going to try to rationalize them, essentially by building a dynamic theory of building reputation as a global safe asset provider. So investors are going to fear that opportunistic governments might impose ex post capital control. So if things get bad, money is leaving, there's going to be a temptation to essentially lock the gates in order to reduce inefficient liquidations and the interest rate. And so at kind of a low and early stage reputation, it's going to be optimal to only borrow from stable investors. Endogenously, as reputation improves, you're going to want to open up to flighty investors. And reputation is going to be gained or lost on these policy choices during crises, and it's going to be hard to build. And essentially, we're going to find that it might not ever occur. And so we can use this tractable framework to then study competition and then extend the model to understanding two-way capital flows, really understanding how this incentive to become a reserve currency still exists, even when you're in a situation like China of running a large current account surplus. So in terms of the literature, I think we're building on, this is an unjustly short literature review, kind of the growing literature trying to understand the reforms in China's financial markets. And then in terms of the theory, what we're essentially going to do is, build on this literature on the international monetary system. And what we're going to bring to it is the dynamic reputation models in the spirit of Phelan and Amador and Phelan, and essentially integrate those to understand how reputation as a safe asset provider develops. So with that, let me jump in. So the first fact is kind of the striking rise in foreign participation in the onshore Chinese renminbi market. And so essentially here you can see, this is just going back to 2014, you can see that, from below $100 billion, up to over 600 billion US dollars at the end of 2021, we've seen this rapid increase in foreign investment in Chinese renminbi. And of course, now we're seeing these sharp outflows. And in the context of the model, one of the questions is going to be, is this one of these kind of crises where reputation can be gained or lost? Now, we don't just look at the aggregate. What we do, and I'm happy to discuss this in the Q&A, is we do our best to essentially split of this foreign investment in China, how much of it is coming from kind of central banks and private investors. And so what we can see is the early buildup in foreign investment in renminbi is really driven by central bank reserve holdings, with the big jump in 2017 and 2018 coming from Russia. And then 2019 and 2020, with the kind of pickup in Bond Connect and index inclusions, we see this huge increase in foreign investment in China. Now, one of the things we've worked quite hard to do is, basically try to say this isn't just one investor. This really appears to be from investors around the world. So it's not just coming from Hong Kong and Singapore. You're going to see the United States, the Euro area, Japan, kind of private investors around the world are sending money in. Now, a brief slide on just how China essentially staggered investors' market access to the domestic bond market. So in the early phase, we had kind of the QFII program, where there was kind of onerous approval processes, lock-in periods, and importantly, investors could only access the exchange bond market, so kind of a small part of the onshore market. In the middle phase, we have QFII, and our QFII was extended to the interbank bond market, CIBM. There's going to be some quotas, and importantly, there's essentially still a lot of frictions for foreign investors. So things like it's not compatible with trading platforms. You have to essentially set up an onshore entity. 2015, we see a major reform where essentially there's full access to the Chinese interbank bond market without quotas for direct long-term investors. And the PBOC policy essentially said, it really is targeting these long-term, sovereign or quasi-sovereign entities who are behaving as long-term investors. In 2016, this is really institutionalized with CIBM Direct and kind of a streamlined way for these kind of longer-term and medium-term investors to access the market. The latest phase, 2017, the introduction of Bond Connect, essentially, based offshore in Hong Kong, at the end of, kind of no quotas, you're able to use this from international trading platforms. And importantly, this allows China to be declared an investable currency by large, index providers, Bloomberg, JP Morgan, and recently FTSE. And so what we do is we try to essentially collect data on each individual investor's form of access to the Chinese bond market over time. And so what we can see is that early on, flows into China, this is the CDF of entry into China. We classify investors as stable or flighty. What we can see is the early period, it was overwhelmingly coming from the stable investors. And really with QFII, with our QFII and CIBM Direct, we see a disproportionate, introduction of stable investors into the market. And then in the recent period with Bond Connect and the index inclusions, that's when flighty investors like mutual funds and portfolio managers really begin to enter. Now, the final fact is this question of, who exactly is holding the renminbi and what else do they hold? So we use the universe of, essentially mutual fund, ETF, and insurance company holdings from the US, so microdata on fund positions. And we ask for every investor, if you are investing in any particular foreign currency sovereign bond, what else do you hold? And so we ask for each investor, what share of your portfolio is in currency C or developed market currency? And we calculate the share, and we ask, how close is this correlation? How closely correlated are your shares in a given currency and your share in developed market currencies, which is the G10 currencies, which we're going to think of as kind of the countries with higher reputation for currency stability in international markets. And what we see is essentially China is exactly in the middle. So, the developed market currencies, really the G10, are in blue, and you see that then it's followed by China. And on the right, you see the emerging markets that have this negative correlation with developed market portfolios. So essentially, if you invest more in Colombia, you hold way less of Japan and Europe. But right now you see China, with kind of what I call borderline emerging markets. You can easily classify them as developed: Singapore, Israel, and Korea. And so China is ranking right there in between the two sets of countries. And so with that, I want to turn to basically how are we going to understand and rationalize these facts. And so we're going to do this by essentially looking at this through the lens of dynamic reputation building. And so the model itself, it's infinite horizon, it's discrete time. We're going to consider the possibility that there's either a committed government or an opportunistic government, and investors are unsure of the government type when they invest. So within every date, we're going to have a borrowing and costly liquidation subgame. And then across states is going to be the reputation game. So let me begin by very quickly going through kind of the subgame. So at the beginning of the date, the country, we're going to assume China is essentially borrowing on behalf of the financial intermediation sector. The Chinese government is. The country is going to choose essentially the scale of long-term projects. And importantly, they can do that by choosing the amount of short-term debt D to raise. Now, what makes it short-term? The debt matures in the middle of the period, but the payoffs aren't distributed on the project until the end of the date. And so in the middle date, there's essentially a rollover problem. And in the middle date, the state of the economy is realized. And if essentially the state of the economy is low, foreign investors are going to want to pull their money out, and the government might be tempted to institute ex post capital controls in order to avoid costly liquidations. Now, here I'm going through kind of I'm skipping kind of the risk neutral preferences of the investors and going right to what their actual demand curves are. We're going to assume that there are essentially two classes of investors: stable and flighty investors. In the baseline case, we're going to assume they have homogeneous interest rate schedules. So what's the interest rate that each investor is going to require? So they have some required rate of return R, and then they essentially have a disutility of lending in quantities. So the more you borrow from them, the higher the interest rate you pay, with a slope B, and then the amount you're lending is D. The key variable for us, the state variable in the model is, and what we're going to call reputation, is the probability that investors put on the possibility that if the bad state is realized, that the country will not institute capital controls. And so the denominator is essentially, what is the expected return? How much, it's basically taking out the risk that you face, that in the bad state, you think the government will lock your money in the country. Now, in the middle of the date, there's going to be a constrained debt rollover in a crisis. So the left-hand side is saying, essentially in the middle date, lenders require an interest rate of RL in order to roll over the debt. Now, 1 minus tau is what the realized capital control is. And so essentially the benefit of these capital controls is to lower the effective interest rate that you're required in order to roll over your debt. Why do you need that? Because your lenders essentially require, take a haircut. They're only willing to lend up to, some point of, the returns on your project. So QI is the value of the project, and L is the liquidations. And so essentially what you're going to have is, if you choose to institute this tau, you're going to have to liquidate fewer of your projects in order to satisfy this constraint. The key difference between the two types of investors, stable and flighty, is that the flighty investors are going to require a higher haircut. Essentially, they're going to pull more of their money out in crises. And importantly, we assume that once you institute, the market reforms necessary to bring in the flighty investors, this applies, not just on the marginal unit, but to all of your borrowing. Now, in the paper, we show that there's essentially, the committed, essentially there's going to be an endogenous threshold M star. So investors are eventually going to think, if your reputation is above some level, you're going to now find it optimal to open up to the flighty investors. Why? Your interest rate schedule has improved significantly such that you would like to borrow at more quantity. And so endogenously, you're going to choose to welcome in more investors. Now, the subgame payoff is going to increase in this ex post capital control, kind of how I alluded to. So this V of MT is the flow payoff, to the financial intermediation sector, and you can think the government at any, reputation MT. And so, inside the brackets on the right is the liquidation value of inside equity at the optimal policy functions. And then we have the net worth multiplier, which is essentially how much you can gross up, that liquidation value of inside equity. And you can see there in green the tau. this, you can already see that essentially, what is the benefit of capital controls? By reducing these liquidations, you're going to essentially raise your static payoff. Now, in our model, of course, locking the gates in bad times is always going to have a static payoff. Why don't you always do it? Well, dynamically, you're going to want to convince investors that you are not going to institute these controls in order to gain reputation. I should clarify here, when we think of capital controls, we're not thinking of capital controls on inflows, kind of macroprudential flows to limit that. We're more thinking of investors came in with the expectation they could get their money out, and it's an outflow tax. Now, in terms of the reputation game, government type is going to be assumed to follow a Markov process here. So essentially, the committed type is going to die with probability epsilon c, the opportunistic type with epsilon o. Investors are going to update their beliefs of facing the committed type, which we're going to call pi n, for basically step size n. You can think of that as time, using Bayes' rule. So essentially, if you don't put in the capital control, you're going to see investors' beliefs that you are the committed type increase. And so again, what we call reputation is not the belief that you're the committed government. It's the probability that investors put that if the bad state is realized, you won't put on the capital controls. And so the second expression here for MN, it's not just the probability that you're the committed type, pi n, it's also the probability you're the opportunistic type, 1 minus pi n, times the probability that you mimic the committed type. So essentially, it's not just, do we think that this is exogenously a committed government? It's, will the opportunistic government choose to forego capital controls in order to maintain its reputation? Because again, when I say committed, we're assuming that some types of governments are essentially, they will never consider instituting these ex post capital controls. Now, if you institute the capital control, you go back down to the lowest reputation. Now, we're going to conjecture a Markov equilibrium. So there's going to be a cycle interval, steps, from 0, the date you're at the lowest reputation, all the way up to capital N. Now, the opening update, N star, is the date at which you choose to let in flighty investors. And the graduation step, capital N, is when all opportunistic types deviate. So, just as in kind of the literature we're building on, this is a class of models where you don't keep your reputation permanently. Eventually, even when your reputation gets high enough, if you're opportunistic, you do institute capital controls. Now, let's turn to the strategic choices of the opportunistic government. So first, the value of not imposing the capital control, setting tau equal to 0. So W, so your reputation is MN. If you choose to not institute the capital control, your flow payoff is just what the committed type gets. It's the flow payoff V of MN of not instituting any capital controls. Your continuation value, so you discount that at beta, but you can see that your value, your reputation then increases to MN plus 1. Okay. What's the value of imposing the capital control at step N? Well, what we see is that rather than just getting the flow payoff V of M, you get this benefit GH of N. So that's the increase in the net worth multiplier. You can think that your flow payoff is higher because you have reduced inefficient liquidations. What's the downside? Well, you can see in the continuation value, you go back to the lowest reputation. Okay. Now, the value function is simply going to be the maximum among the two. Do you prefer setting capital controls to 0 and improving your reputation, or instituting controls and going back to the lowest reputation? In this class of models, we're going to demonstrate that there's a mixed strategy. The equilibrium features mixed strategies. So essentially, on path, the government is indifferent between instituting the controls or not. Certainly with different probabilities. That's going to be the key. Essentially, in equilibrium, you're going to have a mimicking probability. Now, what is graduation? That's going to be the point at which you weakly prefer to institute the controls than to forego them, and that's what's going to be the graduation step. Now, let me walk through kind of just a numerical example of what reputation building really looks like here. So at the early stage, what you can see is kind of a fairly sharp increase in reputation. This is assuming that for every crisis, you don't institute controls. The green dashed line is the endogenous opening up step, N star. And what you can see is at that point, we see a sharp increase in reputation, the belief that the government is committed. After that, what we'll see is kind of a more gradual increase in reputation until the government reaches the point where it optimally chooses to graduate and institute controls. Now, what's the benefit of essentially foregoing these capital controls and improving your reputation? Well, here we plot the equilibrium debt issuance and interest rate. And so what you can see is at the opening up step, because this opening up step is going to generate this large increase in reputation, suddenly you face a much better interest rate schedule. You're going to choose, why would you deal with these flighty investors with a higher haircut? Because you're going to borrow much more at a higher interest rate, kind of along the lines of what we see in 2019, that China's borrowing from foreign investors increased dramatically. Now, in terms of the model solution, I'll only give a, in the short talk, I'll give a little sense here. We, in the case of homogeneous haircuts, we prove both existence and uniqueness. In heterogeneous haircuts, we're essentially able to prove uniqueness conditional on an opening update. In terms of the sketch of the arguments, I think one of the nice ways to understand the model is that we're able to characterize the flow utility dynamics in terms of an AR1 process with time varying coefficients, depending on which class of investors you have in. And so essentially the key is on this first term here, what is the benefit of capital controls at h of n versus n+1? At the opening update, that's going to be the point. Once you've opened up, the benefit of instituting, the static benefit of instituting capital controls has gone down. It's harder to lock investors in. Because you've essentially foregone this valuable policy, you're going to essentially be rewarded with an increase, a discrete increase in reputation. By taking this costly action of opening up to foreign investors, a country can generate this kind of discrete increase in reputation, which is kind of one of the reasons we would see these these striking dynamics. Now, in the last few minutes, what I want to do is really turn to a part of the model we're quite excited about, which is how to essentially embed this simple framework in currency competition across countries in order to really kind of understand the challenges that China faces. And so we're going to embed this in a monopolistic competition framework with a range of potential currency issuers. And so importantly, we're going to make two changes here. So first, we're going to introduce this omega I, which is a header of M. It's basically what is the essentially preference for an individual investor I for debt of countries with reputation M. So this is going to allow us to map back to the empirics, assuming that different types of investors are going to be kind of more concentrated in, say, emerging markets or developed markets. The key here is that now the interest rate that you're going to face is not just how much you borrow, but it's essentially how much all of your competitors have borrowed around the world. And we're able to show that you can actually aggregate this really cleanly to a representative investor formulation, where essentially the interest rate schedule faced by a country is going to look exactly the same as in the single country case, except now rather than facing an exogenous slope of an interest rate B, it's now going to face an endogenous B star, which is going to depend on essentially how much debt every other country is issued. And so here what we can have is, and we're going to show, is that the key here is that more competition is essentially going to raise the slope of the interest rate schedule and reduce the benefits of building reputation. Because importantly, this distribution mu, how much time you spend at each level of reputation, is going to be endogenous to the competition environment. And so you can see this here, where we basically plot the path of reputation under competition and under no competition. And so what you can see is, when you're facing competition from other countries, you're going to begin with a lower reputation because it's essentially more tempting to deviate when you face a less appealing interest rate schedule. Conditional on making it, you're going to have a sharp increase in reputation, but then graduate kind of quite quickly. I think kind of the key benefit of moving to this multi-currency framework is you can really kind of look at the changes in the stationary distribution. How much time do countries spend at different levels of reputation? And essentially, when a country faces reputation, what you can see here is they'll actually spend a lot of time at low reputation, because the less, essentially the steeper the interest rate schedule you face, the less of a benefit it is to becoming the international currency provider. And so the more tempting it is to deviate. This really opens up the question of, well, where is every country now? And so what we can show in this multi-currency extension is, well, let's say we do exactly what we did in the empirics. We measure what share of any individual investor's portfolio is invested in a given currency. And we can then say, let's take a stand and say there's a set of countries, the G10 as we did before, the developed countries, that have a high reputation. We can then calculate, essentially we can show in the model, the correlation between these portfolio shares is going to map exactly to the correlation of these different taste parameters. So it's essentially an observable measure of a country's reputation. So what we can show in the model is that as a country's reputation converges to that of the high reputation, developed market currencies, we should actually see a change in the time series. And this can actually be estimated using private investor holdings. And so that's what we do. And so to give you a sense of how this works, we now plot the time series for kind of a key set of countries. So first I begin with the Brazilian real and South African rand. Classic emerging market currencies where we don't think there's a big movement in reputation and sample. And we see indeed, there's a strong negative correlation with developed market positions the whole time. Similarly, we think the dollar and euro had fairly high reputation as stable currencies during this period. And what we find is a striking and high stable correlation between these currencies and other developed market currencies in sample. China really stands out in kind of a kind of striking jump in, not a huge jump, but an increase in China's correlation of the renminbi in portfolios with developed market positions right in 2019, kind of with this explosion of Bond Connect and the inclusion in the Bloomberg Global Aggregate. And so this is kind of providing support or helping us understand the model. We still see that, we'd say China has a long way to go before the renminbi is viewed like the dollar, but we do see these reforms, significantly increase this correlation. And of course, it's going to be very interesting to see what happens with this measure going forward. But so I see here, so the final thing I really want to spend time on is, in this competition framework, what can the other countries essentially do if their goal is to maintain their position as an international currency provider, say the US? So generally, what we're able to prove is that if competition is sufficiently fierce, so the slope of the demand curve you face is above a threshold, all opportunistic countries are going to graduate. Essentially, if you know that the benefits of scaling up your debt issuance are low enough, you're not going to be able to, avoid the temptation of instituting capital controls. So in this framework, if we suppose that a large country, say the United States, internalizes the impact of its own issuance on the reputation building incentives, it would actually, and behave to say a Stackelberg incumbent, it would face the incentive to essentially flood the market with safe assets, essentially lowering the benefits that a potentially challenger like China would have of becoming the reserve currency. Importantly, that statement abstracts from the possibility that the US undertaking this strategy would lead to its own loss of reputation. And so more generally, we see that this higher issuance of safe assets is going to reduce the probability that any competitor can essentially develop its reputation. Now, I'm not going to go into this here, but you might wonder, this is a model all about building a reserve currency in order to borrow more. What we show in the paper is you can essentially divorce the current account from basically gross positions in renminbi. And so it's an argument, why would China want to do this even if they don't have net borrowing needs right now? Well, if China is able to develop its reputation, they can essentially borrow more later at a cheaper interest rate. And so it's essentially like a pledgeable asset. But with that, let me conclude. So we think that the integration of China's bond market and currency into the global financial system is, potentially a watershed moment, for the international financial system. In terms of the empirics, so far we've documented this rise in foreign investment, official then private, the staggered entry of investor types as a policy choice, and this way to measure essentially where the renminbi appears in portfolios. We think that this simple framework allows us to understand the way in which reputation can be built. Of course, it's consistent, the framework is consistent with slow progress and setbacks, pointing to a difficult road ahead. And I think we've kind of highlighted, how the competitive environment can change the incentives. And with that, we're really looking forward to Zhiguo's comments. Thanks so much.
Thanks a lot, Jesse, for the great presentation. We are 3 minutes behind our schedule, but
Sorry.
This is an incredibly rich paper. I think we're very happy to see the last few slides. Zhiguo, now the floor is yours. You have 25 minutes.
All right. This is a discussion for this interesting paper. When I prepared the discussion slides, I got help from Wei Wei, who's a postdoc at BFI China, and Zhao, who's my co-author on some paper that are related. So this is an important paper on China's financial reform. Why takes Jesse and Chris and Amada and also Matteo to write this paper. I think the unique part is that they have a very interesting data on the foreign side to look at how does the China's opening up. I do have my own perspective on how does China opening up. So it's, you know, I invited this paper just because that it's such an important topic, and also that it's very, very useful for a broader audience or researchers to look into these questions. So this is really timely. In some sense, you could view this as a very right timing to reflect our decade-long effort by China's reformists. When I say reformist, you must know who I'm, you know, about a set of people that I'm, you know, you will be familiar with. For outsiders, I do think that if you interview anybody right now, it's kind of a crossroad. And I can tell you my view is the direction of a controlled opening won't reverse, not at all. But what is less clear is the is like economic growth, which I think that fundamental really affects the recent month or recent years of the flows that I will show you a bunch of figures on that. I'm gonna spend some time in explaining to you the execution of modeling. To be honest, the paper is I would say 75%, 70 to 75% of meat is on modeling, which is quite nice. And I will tell you the mechanism, what is behind it. It's a reputation model, but there's a lot of nuance behind it. And I want to mention that it is perfect from foreign investors' side, from their perspective. If you ask them, they clearly worry about the thing that Jesse is talking about. Now, when you think about the modeling ingredients and asking them whether this is really the China's government side, I have some questions. As you know, I will explaining to you that what is behind this Krebs classic modeling of the reputation. So this is my plan. So I will first just review several pictures that I really think that it's not totally new. The first two slides are not totally new to me, but it's still very interesting in the sense that putting things together, put that perspective. So first, the first picture is a really staged opening up, and what they show here, it's just a copy from their paper. It's a CDF, so you can think about it like at the end of 2020, at the mid of 2020, probably they take that as one, and then figuring out, you know, how do you rise from 2004 to 2021. And something take away is that there's some big events, right? You can see all these lines that it just indicates important events. And you see that the stable guys, so defined as a central bank, you can think about it, central bank or sovereign wealth funds, basically, you know, there's it's just rising faster or before the entry of a volatility. Now, in this picture, you can see the pace, right? You can see the pace, but you do not know whether the size also follow the same dynamics. So here's a size. It's a composition of a foreign ownership of Chinese issued RMB bonds. So from here, you can also see that just the size-wise, relative between these two investors, it's also follow this opening up steps. Okay, so these are the two important facts, and I think I know, you know, you probably do not know, but I think that this is a very good way to summarize what's happening in the last 10 years. One intriguing factor, which is totally new to me, is they use their own data, which is this Morningstar data on the fund from the foreign perspective. Obviously, this is their advantage. Is asking the question that the Chinese bonds are more like emerging market bonds or developed market bonds. If you're asking me, actually, I really do not know. Any answer coming to me, I would not be surprised. Or in some sense, if you give me a very interesting answer, I will be very, very, eager to know. So one thing that you might just look at the return of your Chinese bond and compare to, U.S. bonds or, South Africa bonds, but that's not a good idea. They're using their holding data really tell us the interesting facts, which is that when you look at their portfolios, right? Portfolios, the funds are holding developed countries tend to also hold the developed countries. There's a specialization going on, or market segmentation, or mandates going on. So what they show is basically that they see Chinese bonds are kind of equally sitting along these investors who specialize or mandated to hold the developed countries' bonds, as well as those guys who are actually specialized or mandated to hold these emerging market bonds. So that is, to me, it's like, China is in the transition, and it's a very interesting experiment, a big country that into this perspective. This is why they write this paper. One thing that is interesting, this is when I read the paper, I usually using the a pen to put some circle. So the way they put it here is like here's a China, right? China, and then the left is they call it DM, the right is called EM. I do not know, is that the definition of because of this, or just coincide with this definition? So when I see it, there's a Singapore, and here is Israel, and then this is the not South Korea. It's the Korea. Yeah, South Korea. And maybe according to some definition, they are EM, but I do not know. And the other guy, the other side is Norway Corona. Okay, so I do not know, would be useful to really, in some sense, clarify this classification issue. Okay, so let me move on to the model, and then quickly go through the model, just making sure that you understand that there are key logics, and then I will show some slides that are on for the audience of more like Chinese audience, where important facts that are what's going on now for this particular question. Then I will comment on how do I think about the model elements. Okay, so stage game, Jesse already kind of explained it to you. They're clever in the sense that they're really good modelers, putting all these things together. Yeah, and so there are stage game. The stage game has a beginning of a date, middle of date, and end of date. Why do they need that? They need a rollover. They needed this middle date to have a chance for the country to get into a bad state, which is a crisis state, and as a result, that the government at this point can impose some exposed capital control tower, and obviously these government will care about the reputation, and this is how it goes. And then the next day is coming again, and then just repeat it. Okay, so there are two kinds of government. One is a commitment type, never impose capital control. In our mind, in my mind, obviously, maybe the hardcore reformists. They didn't mention it. I do think that it would be useful to mention this. The other one, the other type is called opportunistic type. They value short-term gain from imposing capital control, and every day they are thinking about when should I give up? Okay, and I will comment on this interpretation of opportunity type later. Okay, and then they put the stage game in infinite horizon reputation model. It's Amado Phelan, a nice paper of that paper. Then they put it in with some new addition to it. It's adding a twist of basically first stable, then flight, basically. Okay. In crisis state, this is just one slide telling you the key results. Is that they're assuming the required haircut will be larger if flighty investors are allowed in. It is as if that the flighty investors are running, and the government can kind of reduce the painfulness by doing something, by simply tax outflow. So you can see that in the bad time, this is a really bad time, because the haircut is higher, that means that the right-hand side is really small, but you need to roll over a big chunk of debt. So how do you do it? You just tax the whatever the maturing guys, so that the total debt that you need to roll over basically gets small. Okay, it is important to first establish that a utility flow to the government, the VL, L is the liquidity crisis state, is increasing in tau. So on this on the utility flow, all the opportunist guy really would like to increase tau. Increase tau means that it's just imposing the capital control. This obviously hurts debt holders and whose return is cut really by tau. So that's the important ingredients putting together, which implies these two things. One is imposing capital control exposed is tempting. So for these opportunities guys, and then the expected capital control negative affects debt investors' demand because they understand that the return will be cut by tau. How much will be affected depends on the reputation. So this is what I'm going to. The reputation in this type of model typically is the probability of government being a committed type. Okay, but as you can, Jesse already told you, here is the the way these model works on these dynamics is along the dynamic path. Actually, the opportunistic guy will randomize just because they're indifferent between giving up versus getting a one step up higher. So what is really in the end what matters to the investor is just think about the equilibrium probability of no capital control tomorrow, given the state of the crisis state. So they call it a big MT. Big MT is you're a good guy, or if you're a bad guy, but you randomly decide not to kill me, right? So that's the endogenous probability, and not to impose capital control, or you could interpret as a reputation. These MT and pi t are endogenous equilibrium variable anyway, so they just have a one-to-one. So it's enough to keep track of one. So that's very nice structure where you have this stationary structure where each step that the government will gets into the crisis state, and if they decide not to capital control, then their reputation go up. And why they do that? Just because they're indifferent. And as a result, that people gets released, saying relieved, saying you probably is a committed type. I will come back to this interpretation a little bit later, but here you already see that debt demand has this feature, which is increasing. The price is increasing the reputation and obviously increasing the R. Right? Okay. So here is the way it works, and I wanted to just make some comment on that. So committed type of strategy, first of all, it's very important, is that the first step for them to show the entire, putting all these things together, is that facing low reputation, committed type would like to start with stable investors with a lower haircut in prices. Okay, that's a static model results because these committed types are not thinking, dynamically anyway. That's an assumption, but this is usually we do, and I think this is okay. And why? Because the flighty investors are less valuable, just because of when things are bad, they will leave anyway. So that's why this affected their valuation. As a result, the first dollar, the first stable dollar is always better than the flighty dollar, and so therefore that the committed type will do that. And in equilibrium, it's very important. The opportunist guy will mimic, but the investors seeing that exactly same strategy, they're going to try to figure out who you are, which is how this the reputation getting. But it is important in the static model where committed type, because they're facing quadratic adjustment costs on these holdings that Jesse was talking about. So that is, at some point you raise too much dollar from the stable guy, you're just tapping another door, which is the flighty investors. So you see that a committed type started with the stable and then go to this flighty, and this is exactly why that the opportunities guy, when they try to mimic whatever committed type of strategy, you see this slide opening up. But the question is that when do you open up, right? When does the opportunities guy allow for these flighty investigating? That gets into the complicated equilibrium inference. And this is the here that was what I wrote is about the indifference condition. So here's a mixed strategy of opportunistic government for general MN belong to these, these steps. This is interesting. This is always steps. The opportunistic government needs to be indifferent between two things. One is just basically just, kind of like announce to the people, I'm the bad guy, sorry, good luck. Imposing the capital control, or just saying, I'm not shutting you down, getting a reputation elevated to the next step. The last point is something that I feel like, you probably wanted to defend a bit, which is a kind of, it's a problem, in my mind, it's a problem of opportunistic modeling of a reputation. So for these opportunists guy at a graduation step in is very, very high. They have an excellent reputation. And because the future reputation cannot motivate them at all. Furthermore, the temptation of reap the reputation gain is too big. So that's basically Krebs-Wilson 1982 model and there. So a long time ago, I was trying to study this type of model, and it has a kind of interesting or funny issue is that the optimist guy is basically they're trying to behave good so that in the end they can get a lot of gain by just cheating. So this is in some sense that probably if you look at from the China side, government side, there's a lot of different interpretation or disagreement on what's really going on. But from the investor side, I think it's perfectly like they exactly worry that what if you just shut down the door and will not let me to get it? Okay, so here is the last slide for explaining their theory, and I will be done with describing a bunch of pictures that I made using the China data. What I want to say here, here's one thing that I do think that you will be, as a theorist, for me, I would like to know is that first of all, they show that there exists N star as opening threshold on these steps. It's interesting that this is exactly their contribution relative to relative to Amador Flam. One interesting implication, they didn't prove it, but from their explanation seems to be very general, which is that exactly at the point of opening up, the reputation gain rises the most, and it's also where the debt increased quite a bit. Also, the interest rate dropped quite a bit, as Jesse was showing. I would like to, if you can show some conditions behind it, that would be useful. All right, so I'm almost done with the commenting on this, on explaining this paper. Let me just tell you, just let you know some of my thoughts on assess this paper, and also like maybe it will be useful for you to get a little bit more data on that. The first question that when I read this paper, and Michael knows that I often question. I also have a paper on this issue, questioning about what are these foreigners. They call them foreigners, and but look at the names, probably not. So this is with the help of the Weiwei. So China actually establishes the entire list of these foreigners. And what we do is just Google them. Some of them are very, very clear. They are not the foreigners. Some, for instance, that, the BOC office in New York, right? That's clearly not. What we, and I myself is, I should have learned quite a bit by getting this plot, is that you can see that as a percentage over years, unfortunately, we do not have data before 2017, is that foreign countries' percentage increased steadily, which is exactly consistent with their paper. It's also that it's increasing, and the mainland China, which means that like a BOC overseas office, okay, it's kind of steadily goes down. So there's another dimension. Seems like this is related to Michael and I and Jesse were talking about it. There's some offshore market where a bunch of Chinese foreign, operator institutions are operating, and they can behave as if foreigners, and they initially played bigger role, and then later on, slowly that indeed these authentic foreign players are getting in. I think it's something that you never talk about in the paper. It will be useful to just comment on that. This is the second last slide. The recent trend, I have to talk a little bit about it. Starting from 21 to 03 to 22 07, this is the data that I only have that. What I'm plotting here is a UCD, is a US dollar to CNY exchange rates, and today is about a 6.9. So there's some concern about that. And you can see that starting from 2022, indeed, it dropped quite a bit. So there is this recent trend is a I wouldn't say concerning, but it's just a normal correction that we were facing right now. The last this picture is to showing you that the balance share owned by foreign investors also goes down. So here is total outstanding. Here is the shares owned by foreign investors. Similar picture. This one is that the stuff with Zhiguo is just showing you the offshore USD bonds issued by Chinese companies. So one thing I wanted to just highlight is this corporate bonds of the real estate. This data is coming from Bloomberg together with Wind. Corporate bonds with a real estate is just basically shrinking over starting from 2020. From 2021. This is another version of internationalization, right? Just from the Chinese perspective. Okay, so this is my last slide. It's a nice paper, important implications for internationalization or bigger good emerging economies. This is definitely a first order factor. Besides my understanding of what's going on from the China side. First of all, it's a reformists versus the conservatives. Obviously reformists is always pushing for the opening, staged opening. Conservatives always see that we do not know what's going on. And as a result, is it intrinsically linked to this learning by doing idea or experimenting. It's important to differentiate these two because what their paper is basically learning of the foreigners. Like foreign guys always thinking that, oh, I care about your imposing capital control and I want to learn your type. But from the China side, a lot of times they are also learning. I believe they're also learning. They're learning something else, right? So those are the two things that, you deliver your learning by this reputation model, which is totally fine, totally making sense. But if you cannot pushing too much about this committed versus optimistic. Last point is what they were talking about, this idea where for United States to stop China of the reserve currency is to issue a lot of debt. I would imagine that probably Janet Yellen will be happy to hear about that. Also the Powell will also be happy about that, but probably not the Harvard Grumpist economist, which is Samuelson. Have. And let me just stop here because I think that there are a lot of things to discuss.
Yeah, thanks a lot, Zhiguo. So Jesse, do you want to have a quick response to Zhiguo's discussion? Or you prefer to take some questions?
I was going to say, I honestly just want to say thank you. I think that a lot of the stuff, are things we could think about. We talked a little bit the offshore stuff. I agree. I think we could absolutely do more. And on your point of is it really foreign or not, one of the things we did that's not in the paper that you've got me thinking about is because we actually collected the individual issuers, we actually did a lot of work to basically say, are you Hong Kong on a residency basis and move to where you'd be on a nationality basis? And it's not there at all. And I think that your comments highlight that we should actually talk about the way in which money is entering China based on either, a financing subsidiary based in Hong Kong, what foreign actually means. I think that there's more to do there. So basically, thanks a lot. And yeah.
Okay, great. So let's take some questions from our panelists. Aisha.
Well, thank you, Jesse and Zhiguo, for presenting and discussing such a nice paper. I just want to understand. I see the pictures. I saw Jesse's data stopped in 2020, and Zhiguo also mentioned, what happened in 2021, 2022. So I want to know. So Jesse, what's your take on what happens right now? Because the emerging market, developed market, are they going to switch over recent time?
So I think that right now, so the reason, in the initial graph, the reason where we were able to extend the aggregate line, right now, what we cannot do yet, and we'll work on this when we have the data, is basically get to who was actually doing the selling. And so, when the selling initially began, there was speculation that, say the Russian central bank was selling as a result of not being able to touch their dollar reserves as a result of sanctions. Because the outflows continued so much, my conjecture, and this is beyond the paper, is that it is likely coming from the private investors. Now, what I don't know in terms of the measure of the portfolio correlation, the direction in which that would go is whether you basically see parallel selling between, let's say funds tracking the Bloomberg Global Aggregate, so global bond funds versus emerging market focused funds. So I don't know, which investor was selling. That'll be, but that's basically what we have to do in order to see that. In terms of through the lens of the model, how we would think of this, the way we think of this is actually, kind of a parallel to 2015 in the sense that, the last time China saw these large capital outflows, there was huge speculation on, whether or not there would be restrictions on foreign investors getting their money out. And even though there were restrictions on, say, domestic investors continuing to, take money out, essentially foreigners were able to withdraw money. And, from the perspective of the model, that would say that was actually a crisis where the gates were not locked. A reputation increased, and then we saw opening up. So I think here the question, where I have no forecast whatsoever, is at what point, how bad are things before that temptation to intervene gets going. Through the lens of the model, what we would say is, if things are bad and the gates are not locked, foreigners would then say, well, we think that actually, China appears to be willing to essentially deal with pain without locking the gates. That's how we'd interpret these events right now.
Okay, thank you. I have one extra question. I'm not a modeling person, so I understand the model is quite complicated already. But I want to know: is it possible to include further elements like the underneath economic conditions? That would be one thing, and the other thing would be the political concerns. That would be the second thing. I think somebody in the audience also asked the same question. Do you think that's possible, or that would make the model too complicated? There's no way to solve it.
So I think, first of all, I think what you're saying is true. In some sense, of course, during this period, China's economic conditions have fundamentally been changing. And so we would expect, say a share of the global economy would be changing. You'd expect that to vary. So right now, I don't think that we could have, you might be able to add something like a deterministic trend. What I don't think we would have is, because essentially we need an opportunistic government, kind of as Zhiguo alluded to. The committed type is not, kind of a fully optimizing in the sense of, playing the full dynamic path. What we need is the opportunistic government to essentially face the choice: am I going to, mimic the policy of essentially my mirror image, who happens to be committed? And so if we were to introduce these things like time variation, who you're actually mimicking would change over time, and that makes this class of models a bit challenging.
All right, thank you.
Okay, we have a question from Bernie. Unfortunately, there's some technical issue on his side, so he cannot really speak up. But let me read his question to you. So basically, he wants to know what will happen in the model if China makes a mistake, say that China somehow chose to cheat, and then it's off equilibrium, and then China wants to get its reputation back. So what will happen in kind of post-cheating equilibrium? Say that in history, U.S. might have made some mistakes, but eventually it manages to come back. So what will happen in the model?
Absolutely. So in the model, it'll be quite stark that in the event that you institute capital controls, I should have said, going quickly here, we don't have, say, an intensive margin of capital controls. We basically say either you institute tau bar or you're at zero. So, in the lens of the model, once you institute controls, you're revealed to be opportunistic, you go back to the bottom. You're not permanently there. Then it would basically be the next crisis. If China does not institute controls, it can rebuild reputation. Now, with a kind of two-state reputation model, that's what you'll get. When I actually, kind of think through history, the closest kind of parallel to that I come up with is the United States, say at the end of Bretton Woods. That when the United States clearly abrogated, the commitment to stay fixed to gold, in reality, what you see is that the share of, the dollar in international transactions falls for quite a bit. And then, in the commensurate decades, the United States rebuilds its position. And so, in reality, I wouldn't think you actually go all the way back to the lowest reputation, but I think there's the sense in which, once you've been revealed to be that type, you'll then have to basically restart the cycle and rebuild the reputation and convince investors that was, there's a chance that you're essentially different going forward, and that wouldn't happen again.
Yeah, I think that's a very clear answer. By the way, Bernie wanted to say he loves the paper and he would like to
thank you very much.
Both authors and the Zhiguo. So now let me ask you two questions from my side. So I would like to follow up with on Zhiguo's comment about the mechanism, the model. That is, think about why the opportunistic guy wants to cheat, and he wants to basically, if I understand correctly, the model in the model, that guy wants to cheat because he expects a significant decline in interest rate, the borrowing cost. But if you think about what happened in China, even if you see this rapidly growing, foreign holding of Chinese government bonds, still the overall size is relatively small. And you don't really expect that, say, even, the hardcore, I don't know who is the other side of what Zhiguo said, hardcore reformists, say that someone is really want to play the game, want to reap some benefits, but the game is so small quantitatively. Just think about, by attracting, foreign money to come, you will be able to lower, the borrowing cost of the Chinese government significantly. But that's just an illusion. It's although, I think the model has a first order factor, as Zhiguo said. But if you think about quantitative importance of this mechanism through, the effect on interest rate, the reputational effect on interest rate, how much you can get money from outside, I think so far it seems to me it's still very small. So that's why I want to ask you about, how you think about this. Maybe, using the numerical examples you show us, the drop in interest rate in early stage is actually very big. But maybe the model really doesn't require such a dramatic decline in interest rate to have that intuition or mechanism, right? So I want to hear your thought on this. And the second thing is, you didn't mention at all, the role of reserves in the model. So I think if I imagine I'm talking to a policy maker, they got to he must in his mind he must have something about the importance of the reserves. Say that look at this size of market or foreign holding of government bond, and now it's still like I don't know, I don't have an exact number in my mind, but a quarter of foreign reserves of the Chinese government. And then if the market continues to grow, if we in uncharted territory say that, you know, the size of the market is way beyond reserves, then I think, you know, the story could be quite different. And now in this model, you don't have anything like collateral or, you know, how much reserves the government is holding and why that matters. But maybe, you know, I just curious to say that how you think about the role of reserves in general. Okay.
Absolutely. So to the first point, and I should have been more clear on this. The numerical example there, we call it a numerical example, not a calibration, because that is set to make the pictures clear. The drop in the interest rate of that magnitude should not be taken seriously. And in the sense that I agree right now, like, you know, basically, I do not want you to infer that we're saying that there'd be, you know, 5 or 6% drop in the interest rate. In fact, one thing I actually want to make clear here is in the baseline model we presented, which we wanted to make clear the only two things that we need, the only one thing different between investors we need is a difference in haircut. Okay? In reality, you might imagine that there are other differences in, say, the demand schedules of the stable investors and the flighty investors. It might be that foreign central banks have a lower required rate of return than the flighty investors. And so that's the sense in which it's quite possible, and we explore this you know, in the appendix, that opening up to flighty investors, you know, you actually might not experience a drop in the interest rate if what you're endogenously doing is scaling up your borrowing, you know, so much that you actually could end up, you know, not seeing a drop like that at all. More generally, though, the key for us is that the imposing the capital controls, and imposing the capital controls is essentially the key tool for mitigating the downsides of a capital outflow. So because we thought, you know, we kind of take building on the kind of the canonical models of financial intermediation, this framework gives us a clear reason why money leaving is going to have a downside. So, you know, we abstract from, you know, something Zhiguo mentioned of, at the times of capital controls, the exchange rate is depreciating. You might imagine that there are kind of other externalities from that you would like to mitigate. So we've gone for, you know, what we think is a fairly clear reason of, as money is leaving, you can essentially reduce the benefits in a static sense of this capital flight by imposing the controls. That's what's important to us. Now, in the long run, I agree with you right now, and this is another point where the you know, the numerical illustration, you know, isn't making clear where, it might not make clear where China is. There's a sense right now where the interest rate effects of foreign borrowing are, you know, small. You know, there's a question right now of, you know, if foreign capital is very, very flighty, there's still a chance that you know, foreign capital outflows might lead to significant price effects. But putting that aside, you know, the goal that, or at least we've modeled it and how we would understand it, of providing the global store of value is precisely this idea that because reputation is this pledgeable asset, the benefit of accumulating this reputation is this ability to borrow a bit, is to essentially borrow more later. And so even if you know, right now the magnitude of that interest rate manipulation isn't enormous, you know, essentially it's proving that that temptation is not going to bite, it's going to allow the benefits of this future borrowing. In terms of the role of reserves in the model, basically where this would show up, and I think it's very interesting to think about, is we haven't given the government another costly tool to prevent liquidations. So in some sense, we have given them only one policy tool, these capital taxes, if they would like to, you know, reduce liquidations. And so, you know, certainly in 2015, you saw the government essentially offset, the Chinese government essentially, you know, spending huge amounts of reserves in order to offset these foreign capital flows. I think, you know, one of the challenges with integrating this fully into the model would simply be to expand the typeset of the action space of the committed type. But more generally, I think that you want to think of, you know, using reserves are not free. It's some costly action, but I think the way I would think of it is giving the government a costly way to reduce liquidations that would not have the reputational effect of locking the gates. That's how I would always think of it.
Thank you. Time is almost up. I think I overlooked questions in Q&A box. Jesse or Chris, would you like to take a quick look?
Oh, I apologize. I wasn't looking at that. There.
And yeah, just spend 30 seconds reading the questions, and then
absolutely.
I will make an announcement. The next speaker will be Wei Xiong. He will talk about the big tech lending model. And the presentation has been scheduled on October 20th. And discussant will be Yao Zhen. Yeah, Jesse.
Absolutely. So first, let me go for so to what extent are the central bank holdings of renminbi motivated by political considerations? Interestingly, so this is actually the hardest one for us to answer, because while we are able to unpack the private ownership of renminbi, it's actually much harder to get the bilateral ownership of reserves. So the way that you can get the aggregate share of renminbi reserves is essentially the IMF COFR data. And there, essentially the deal is countries will give the currency composition of their reserves, but they won't allow who disclosed that data to be revealed. So you'll see the aggregate, not the bilateral. So in terms of political motivations, Russia essentially announced that they switched in order to avoid US sanctions. Kind of related to something that Zhiguo mentioned on, this would be a case where, we didn't mean to minimize the idea that, when, that of course the Chinese government learning in, its own, it's certainly learning as part of these policies. This would be a case where knowing that you're borrowing from a central bank, you should be able to infer, what they are doing, kind of their actions elsewhere. Similarly, when you're borrowing from BlackRock, you might be able to infer their actions, from elsewhere. In terms of the other questions of, the renminbi as a transaction currency, basically, we've really wanted to zoom in on the store of value function of an international currency. In reality, I think you're right. There's going to be complementarities between the medium of exchange and unit of account. We really wanted to focus on the store of value, really because we think it's going to be quantitatively large, that these markets are enormous. And so if you believe that there are essentially monopoly rents to be gained by issuing this currency, we thought that was the first thing to focus on. But, of course, the work of Barry Eichengreen on how do you structure, optimally, which sector do you integrate, do you internationalize first? There's clearly going to be complementarities here, but we chose to focus on, the area that we had something to say and we thought was, particularly important in our, for the policy reforms now.
Yes, thanks a lot. We're running out of time. Let's end this really exciting webinar. And let me just thank everybody, Jesse and Zhiguo, for participating in this webinar. And see you next time.
Thank you so much for the opportunity. Thanks so much.